Now, as we head into the product side and go through demand, where's supply, where do we think demand's going to settle out, and then what does storage look like within the U.S.? It's always important to appreciate kind of where we were and then where we think we're going to go now that COVID is continuing to be a problem, and as we come out of the holiday season. So before we get in, please like, share, subscribe. You're sharing this with other people, getting them to subscribe obviously helps us keep this available for everyone. So as we look at a USA product supplied, so this is looking at gasoline, jet, disti, and resid in order to understand kind of where things sit, where things are. The current total demand for those areas, it's about 11.5 million versus last week of 13.2. So you can see obviously that big drop off. We continue to think that we'll average something much closer to about 13 to 13.2. Obviously, we had a big drop off. And as you can see, when we look at the previous years, we always start off January, fairly low. It's typically the low of the year. As you're getting back to normal. You're not doing as much. You're maybe just kind of in that lull. You're not going to the store as you got gifts or gave gifts, and maybe you're going to return things. But again, you're not really doing as much. And that's usually what we're seeing here. It's just obviously at a much lower and reduced level. We'll start to see some of this normalize. It's just, that's why next week will most likely be a nice increase in demand. The question is going to be, what does crude storage do? But even though we're going to see this normal increase, and as we normally see 2018, 2019, 2020, we normally get that natural bump. It's just obviously starting from a much lower level. The slope won't be as aggressive, and that's why we continue to remain concerned with where oil demand will be in the U.S., just given how there's just not as much demand for refined products, which obviously keeps us cautious on refinery stocks and just what are their crack spreads going to be, what is their margin going to look like, just given that we have an increase in feedstocks because they buy oil to sell products. So the question is going to be, especially as prices go up, are you going to look to buy more or less crude, gasoline or other, just given if some of these prices increase. Obviously, they're still off of highs, but it's something to consider as people still are out of jobs, not in the same type of economic situation, which is something we'll talk about in our economy show. So here, just kicking off with distillate, we had a big build of about 6.4 million barrels. It was really driven from Pad 2, Pad 3, and Pad 5. Imports, as we talked about, really dropped just because, we had that last kind of surge of imports from Europe. But you can see that even though they dropped 316,000 barrels a day, they're still above the year-over-year 5-year average, just because we still are at these levels that we normally don't see, especially just because, again, Europe is trying to kick out as much product as they can as we get an extension of lockdowns or renewed lockdowns, depending on, the semantics, if you will, where the UK is now, back into a lockdown. Germany's extended, Austria's extended. And then, as we go into Asia, Japan is talking about one for all of January. Again, that's why we're seeing the Europe that is trying to kick out product and sell product, and we're seeing a lot of it kind of slosh around trying to find a home, and that becomes the overarching problem where, when we look at oil demand with so much product sitting out there in the market, you're going to have to clear the product in order to get some of this normalized oil demand, and that's when we can kind of think about what is Saudi doing, what is the plan, and it's something that will go in depth in the OPEC show. But here's where we're starting off. So obviously we're starting off the year at higher levels. But when we look at the last 5 years, and that's again looking at the 5-year average, we're only about 8 million barrels above the 5-year average. We're 19 million above year over year, and you can see that's really driven by Pad 1 or the East Coast and Pad 3. And that's why we're going to continue to see this kind of sluggish demand, just because heating oil is really where we see the headwinds, but we do have that benefit from trucking, which we'll talk about in a bit more detail. But here you can kind of get a sense of, we're still at elevated levels when we go back through the historics. Now, when we look at demand, as we were saying, we thought we were going to come in at the lows. Here we're actually setting a new seasonally adjusted low for over the last 5 years, and you can see it's just there'll be a snapback. It's just there was a huge drop to the downside. There should be a snapback, and as you can see from that 5-year average, there always is that big snapback. The question is going to be kind of how high does it go? And that's where we think there's going to be a little bit of a disappointment. It'll follow the trend. It'll definitely go up. It's just going to be a matter of kind of where does it shake out, and we're thinking it's going to track the 5-year average. It's just going to essentially shade below it, just because there is that headwind on some of the demand factors. Now, when we look at trucking, as we've been talking about, we thought it was going to start to fall back, but it exploded to the upside. And here we're now at 136. And when we look at the ISM data, the PMI data, manufacturing, this is something where we're actually going to have to take our estimates up. So we were thinking that it was going to stay between 95 and 105. But when we look at the bottlenecks that are being created again from coronavirus, and it's something that we'll talk about in the Econ show as we start to look at the time to delivery, we're seeing a huge increase in time to delivery, which is making those numbers look a little bit better than they really are. But we'll talk about it as we kind of break them apart. But this is something where clearly they're going to need logistics. They're going to need more trucks to try to backfill and to make up for some of these shortfalls. So that's why, here we're thinking that it's going to be probably closer to 105 to 110, 120. And here, when we look at the bottom to look at where we are over the last 5 years, you can just see how we're blowing 2018 out of the water. And when we look at availability, so truck availability, shifting to lows here as we're coming all the way down, that's going to start to push up pricing. That it just means that there's just more stuff on the road, so there's going to the demand's going to remain elevated. The load availability again is coming down as we're starting to see more trucks go into service, and that's just, if we look at rates are just going right back up to the highs. And if you look at it, we're coming really close to where we were in 2018. In terms of where those highs are, again, just as the logistics remains a big problem with these bottlenecks, we're going to continue to see these trucks get pulled into the market. Now, as we kick off a new year, when we look at rail traffic, so total car loads were down 6.1%. But that sounds worse than it really is, just because when we look at what were some of the big drivers. As we said when we talked last week, we thought grains were going to come into the mid-20s, and they came in with an increase of about 27%. That's going to be, again, that continuation where we're going to keep seeing some of those benefits. Chems, as we go into the new year, will be fairly flattish, versus where we were. But at the same time, 2020 is going to give us easier comps, just given where we were in the year. Obviously, January and as we got into March should be fairly stable, but then obviously March things got a little hairy. So we're gonna see those numbers the comps get a bit easier. But the other nice thing that we saw was an increase in motor vehicle parts. And as we saw GM announce, they surprised on sales to the upside. We should start to see some additional pull through. The problem is going to be obviously petroleum products and petroleum in general, just because there's going to be less crude and refined products moving around. Now, with oil doing what it's doing, maybe we start to see a little bit more activity come into North Dakota and some other areas that rely pretty heavily on crude by rail. And obviously the imports coming from Canada down into the U.S. will be supportive of more crude by rail. Intermodal, as we talked about, it had a big surge. We thought it was going to drop. It still remains elevated, just as we talked about with just the logistics of trying to get stuff into the market. So we think intermodal is going to continue to remain elevated, especially as we go into the new year. And as we close out, year to date, we're down about 13% total car loads. Intermodal units are down about 2%, with total traffic down 7.2% year over year. But now, as we head into the new year, it'll definitely be lumpy, and it'll be very specific as to what are the drivers. And as we talk about in the Econ show in the last segment, we're going to talk about what is happening with grains. And we think that those exports are going to continue to be strong, which is going to be supportive of those hopper cars. Now, as we look at gasoline and shift gears here, you can see gasoline had a big build of about 4.5 million. It was built, we had a build across the board, and it was really kind of driven more by really pad 1, pad 2, and pad 5. And as we talked about with the limitations on driving, specifically in some of these more infected areas, that's going to continue to weigh on just demand, which is going to put more gasoline into storage. But when we look at the year over year and the 5-year average, we're still in a fairly good spot given where we started previous years. So obviously 2020, we set a new seasonally adjusted all-time high, but we're coming in right around where we were in 2017. And as we talked about, as we go through January, typically builds continue to increase. And as we look at just the slope of where things are, we normally track that pretty closely. We'll continue to go up again, just because we get that lull in terms of where the demand is. It's just going to be a matter of how quickly do we get that adjust, and imports still remain elevated. So imports, even though they were down 156,000 barrels, they were still up year over year. We still only dropped 26,000 barrels into pad 1. But the flows are going to remain very stable, and it's just because flows on the route which are coming from Europe to the U.S. Rose in November to 3.3 million tons. Again, the highest since July. December flows were lower than that, but still elevated versus December last year. And it's just, we're still seeing this shift of product coming from Europe into the U.S. For January so far, there's about 14 tankers that have sailed. 7 tankers are booked to load. And again, this is why we're going to continue to see a lot of these flows coming through. And then gasoline stockpiles in the U.S. Atlantic coast for December were at the highest seasonal levels since 1992. So again, pad 1 is where a lot of this is coming in. Pad 1 is the one that's seeing some of the pressure. So typically pad 3 through the Colonial Pipeline will ship north. And we're just not going to see the same type of demand. So there'll be pressure on that. But as you can see, through 2020, we normally see we're essentially following the seasonal norms in terms of movements. It's just obviously from very elevated levels. And we think that it's just going to continue to follow those elevated levels as demand just isn't as robust as it needs to be to clear the glut. And here's an example of why. So when we look at how we closed out 2020, we continue to look out, and someone brought up a good point of, well, let's look at other downturns, with one of them being obviously the financial crisis, and you can see we're still well below all of those levels. And when we look at gasoline demand, you can just see the level at which, or I should say, how far down we are in comparison. Now we'll start to normalize as we normally start to see a bit of an increase in demand. Again, it's just going to be south of that 8 million barrel a day number. Even though we did see some increases in demand, it's just we're not going to see the same type of movements as people look to avoid exposures, especially following maybe seeing family and waiting to get tested after seeing family for not only Christmas but also for New Year's. Then when we look at, how is the world telling us things are going by Google standards, you can see that we're starting to get that, some normalization as some of those things start to normalize after seeing the holiday pop. But again, we normally see a lull in January, and that's why when we look at kind of where we started prior to the holiday season, it's going to remain below those levels and take us a bit more time to get into some of those comfort levels. Now, when we look at gasoline demand, so weekly gasoline demand for the week ending January, or for the week of 12/27, Gas Buddy had us up about 1% from the prior week, and the prior week was down 3.4% from the week before that. So those are things that are going to be, again, excuse me. So as we look at kind of where things are overall, you can see that the trend has been down. And as we talked about on the seasonal level, the trend is normally down. So it's just a matter of how quickly do we snap back. And it's just not something that we think is going to see a quick adjustment. Now, according to Descartes Labs, U.S. gasoline demand fell 3.4% to about 8 million barrels. Again, that's something that's still going to continue to shift lower as we go through the remainder of the year, and that's just because of less traffic between Christmas and New Year's. But again, when we look at that year over year level, that's still down. We still have things down on a year over year basis by about 9%. So we still are surprising to the downside from last year. And then when we look at Descartes, demand has fallen 2 weeks in a row. Now it's at the lowest since late November. Again, not surprising given where things were for travel as people got to their locations or didn't go anywhere at all. And that's going to continue to weigh on kind of where demand is going to go going forward. Now, when we look at Apple mobility, let's just say U.S. is fairly flattish, and that, just based on how this number is calculated, which is going to continue to be flattish, maybe slightly to the downside when we look at the base levels. But Germany, UK, Italy continue to disappoint to the downside and just remain depressed. Obviously, we're not going to get to April levels, but again, we're seeing additional pressures, which is just keeping people off the streets, especially in Europe. And then when we look at holiday impacts, so this is just looking some key areas around the world. Oil demand for COVID, the Christmas shrink. So as we said before, so UK gasoline sales are 32% lower than before pre-pandemic. Gasoline demand in the US was down 9% year over year. And here you can see from essentially December 15th on is where we saw that marked, slowdown in gasoline demand. And it's not just in the US, but this is more of a European thing as well, as we continue to see that pressure. And it's just, we're not going to see that quick snapback, especially as we have people who are going to take some time and avoid the office, at least for the first 2 weeks or until they get tested, given what some of those CDC guidelines are. So when we look at change in commute vehicle miles traveled, this is kind of giving you an idea of kind of where we sit, obviously 2020. So you can see where we were in March, and Boston, Chicago, Houston are all trending towards those levels, LA as well. It's just on a seasonal level, the snapback, if we think about March into April, then we had summer, and summer is always driving season. So we're not going to see the same type of snapback just because we're not going to have that summer moves and those summer adjustments. But again, we will see a recovery. It's just going to be a little bit slower. The slope won't be as aggressive, and we'll start to kind of normalize overall. Now, this is obviously what's giving people pause as we look at COVID metrics in general. Daily tests, obviously everything's starting to pick up. As you start to see daily tests, daily cases are increasing. The moving average is getting back above as we start to see more cases. Hospitalizations remain very elevated. The daily tests is interesting. So my kids had to get tested to go back to school, and each one of them got 2 tests because they do the rapid and then the PCR. So it kind of gives you an idea of like, oh, well, that's why some of these daily tests can be so elevated in comparison, because depending on protocols, you could get people who are getting not just 1, but 2 tests just for that fail safe. If the rapid comes back, let's look at the PCR. If there's a conflict, then you'll do the test again. So you can see how we can accumulate some of these tests. Obviously, daily cases are going to continue to rise, at least in terms of where things are now that we're coming out of the holiday season, and people may have had exposures they weren't aware of. That's going to go up. Hospitalizations, the trend remains elevated, which is the unfortunate side. And as we look at Jan 5th versus the 7-day average, that's going to continue to pull higher. And the unfortunate thing is when we look at the U.S., India is continuing to trend lower, which is a very big positive. When we start to talk about some of the benefits of diesel demand, disti demand, what does that mean? We'll talk about that in the Econ Show. Worldwide, we continue to remain essentially flattish. Not seeing too much up or down. Europe, Middle East, Africa is starting to see an increase. South Korea had a spike, and now it's starting to drop off a little bit. But again, they remain in an extended type of, I don't want to say lockdown, but they've definitely increased the stringency index in order to try to adjust that as Japan heads right into that 3rd wave, which is why they're talking about shutting down for January, or at least shutting down the international flights, having things close at 8 p.m., which again is going to weigh on just total demand. Now, the new thing that we have to talk about is, well, what's happening with vaccinations? And here you can see that the vaccinations continue to get rolled out. The U.S. is a little bit slower in terms of where we are. Obviously, when you think of, how do you normalize this? Just because Israel is a much smaller place than the U.S., but at the same time, we're adjusting this for population. So you can see that things are still starting to increase. The biggest issue now that is being, so when you get the first dose, there is a window to get the second dose, and the window is within a set amount of weeks, and and they give you a 3-day window that you have to get that second dose. Now, as more people are getting their first inoculation, they're starting to get concerned that they're not going to have enough for the second dosage, because we know how it works with the second. We're not as clear as without the second inoculation, and that's going to kind of cap, how many new inoculations do we get, because they want to make sure that the people that got the initial, they get the full allotment. So we're going to start to see a little bit of a slowdown in the new vaccinations as people start to get their second doses, just given how slow it's been to try to get some of this through the system. Now, when we look at jet, this is something that's going to continue to be very depressing, especially as we go into January. So we had a build of about 2.3 million barrels, which again is not surprising given that we're past that holiday surge. So we closed out the year again, as we talked about, kind of those lower highs, lower lows, and we started to normalize into year end. But again, that was kind of that pull through, because we knew there was going to be a surge, as there normally is. And as you look at the other season, as the other years, there's always that spike into year end. So it's just a spike here. Obviously, the slope was more shallow. It didn't have the same increase, and now we're starting off the year obviously well off of seasonal norms. It's just, this is something that is going to tick up a little bit as we kind of backfill after pulling the jet fuel through the system, but we're not getting to where we were. It's just going to be kind of this more sideways movements, but at a very reduced rate, just because corporate travel is not coming back the same way. And right now, as we go into Jan and Feb, this is a lot of corporate travel. There's not a huge amount of vacations. There's some ski trips, but again, how many of those are canceled or not going to happen, or you're going to drive instead of taking a plane, because Martin Luther King weekend is typically another big time for that travel. But when we look at flights, so some 65 more departures week on week, but we have to think about what is all of January and all of Feb look like. And around 2,700 flights on average per day in January and 3,900 in February have been removed from the flight schedule. So we're, again, another walk back from December into January. So January is getting knocked down 2,700, and Feb is getting knocked down 3,900 from December numbers. Obviously, December's elevated for the holiday, but again, this is just going to be kind of that prolonged move. And a lot of that drop is coming in Europe and China, which kind of offsets some of the stabilization that we've seen in the U.S. But the U.S. is also going to start to walk back now that people are home. Then when we look at passengers, obviously we have, there's nothing to tell us that 550 to 750, 550 to 850 won't continue to hold. Clearly we had, the big spikes, as we normally do at this time of year. It's just a matter of, when does some of these holidays fall, which will then kind of shift when people come home. If it falls on a Friday, will you come home Saturday instead of Friday? Which it kind of adjusts where this is. But again, it's something that we think is going to normalize kind of within that level that we saw, and probably even a little bit guided to the downside. Then as we look at Opentable, obviously people went out for New Year's, but we're still not back to pre-COVID levels, even though New Year's which was down about 10%. But we're starting to see those reductions. And as we keep talking about, kind of this stabilization at these levels, just because as we look through around the world, we think that 60% is kind of be the normal going into the rest of January. Canada's obviously is restricted. Australia, without their local spreads, that's going to continue to be the bright spot. Germany extending lockdowns, Ireland extending lockdowns, Mexico still facing issues, UK extending renaming the lockdown from tier 4 back to a lockdown, US restricting, how many people within the facilities. Again, this is all going to weigh on just total demand, which is going to keep us at that 60 to 65% down versus the pre-COVID, which is just going to weigh on restaurants and jobs and just, movements, because, obviously what do restaurants buy? They buy food, they buy, they have to get their stuff clean professionally to make sure that, from a tablecloth onward, this is all going to weigh on just some of those demand points, especially as we go abroad and look at kind of what's happening within the global construct. And is there anything different? Is there some bright spots? And there's obviously some bullish spots. There's some bearish spots, and we'll kind of go through what we think is going to happen, at least through January and into February.